A 50% collapse in under 4 months, from a $126,000 peak in October 2025 to lows near $60,000. Has the market convinced this is a repeat of 2018? The prevailing fear is of another year-long 84% drawdown, a slow, grinding collapse of conviction. This narrative is wrong. It fails because it ignores the fundamental anatomy of the decline itself. The structure of this event tells a story of mechanical shock, not fundamental collapse. The 2018 bear market was defined by its primary characteristic, duration. It was a year-long siege, a slow bleed where the asset made lower highs as market interest withered. This event, by absolute contrast, is defined by compression. We have a 50% drawdown executed in a fraction of that time, driven by concentrated, high-velocity stress days. An analysis of the two simplest variables, depth and speed, aligns this event with acute liquidity shocks, such as the March 2020 crash to the $4,900 region, and definitively separates it from any year-long erosion. Compression is the critical variable that invalidates the 2018 comparison. In 2018, the market had ample time for doubt and gradual repricing. In 2026, like in March 2020, the speed of the event eliminated any opportunity for reflection, forcing a market dominated by reaction over reconsideration. This intense concentration of volatility into a short time frame is the hallmark of a mechanical liquidity event, not a slow rot in the asset's foundation. A rapid succession of double-digit down days is explicit evidence of forced deleveraging, which is structurally distinct from a prolonged loss of conviction. The correct classification is therefore locked in. This is not thesis decay, it is phase behavior. We are observing the execution of a shock pattern, a violent mechanical reset of the system. Interpreting this as an emotional collapse is an analytical error. Based on morphology alone, this event meets the precise structural criteria of an acute shock, not a long-term erosion. To understand this event, one must move past price charts and analyze the engineering of the market structure. The two scenarios, shock and collapse, represent different modes of system failure. Structural erosion, the 2018 model, is a failure of the thesis itself, a slow dismantling of the core value proposition as conviction evaporates over many months. It is a disease of the foundation. A deleveraging shock, which we are witnessing now, is a failure of a specific component, the speculative leverage layer built on top of that foundation. The shock operates as a system integrity test. It violently expels participants who borrowed against the asset's volatility, creating acute stress days and the signature of a 50% drawdown in 4 months. The underlying asset is not being abandoned. It is being consolidated by entities with the balance sheet capacity to withstand the test. Recognizing the difference is the critical inflection point for capital allocation. One failure mode implies systemic decay, demanding capital preservation and exit. The other implies a violent but functional reset, demanding capital deployment to absorb the positions of the liquidated. The anatomy confirms we are in the second scenario. This is not a structural crisis. It is a scheduled mechanical purge. A key confirmation signal is the derivatives reset. Open interest has collapsed by approximately 58%, falling from roughly $56.6 billion to around $23.6 billion, a magnitude consistent with a total leverage flush. This is the mechanical signature of forced liquidation, not voluntary exit. When open interest evaporates at this scale, It reveals that the selling pressure was driven by margin calls and overextended positions being wiped out, rather than a fundamental reassessment of the asset's value. The price action reflects this mechanical unwinding, a necessary purge of speculative excess that clears the path for genuine price discovery. This distinguishes leveraged exit from structural abandonment. In a true bear market, long-term holders distribute their positions over months, signaling a loss of conviction. Here we see a violent contraction of open interest, while the underlying asset remains held by those without leverage. The selling is concentrated in the derivative layer, a symptom of market structure rather than thesis failure. It is a transfer of risk from weak hands, who are forced to sell, to strong hands, who are positioned to absorb the liquidation without distress. Exchange-traded fund flows add context, but must be interpreted precisely. There were roughly $6.18 billion in net outflows across November 2025 through January 2026, although that period also included short bursts of inflows. The net outflows position fund activity as a stress reaction, capital fleeing volatility, rather than a definitive invalidation of institutional demand. The flows are reactive, trailing the price action driven by the derivatives market, confirming that the primary driver of this event is the leverage cycle, not a wholesale institutional exodus. The disciplined claim is not that institutions are absorbing every coin, but that the market shows a massive leverage reset while spot demand signals remain uneven. This asymmetry, a definitive clearing of speculative debt versus ambiguous spot behavior, frames the event as a mechanical shock phase. The leverage has been transferred, the excess has been removed, and the market structure has been reset. This is the function of the shock, to align price with unleveraged reality, preparing the ground for the next phase of the trajectory. The indicators cluster at an extreme, creating a signal pattern that warrants attention. The Crypto Fear and Greed Index has hit historically low readings, reported as 5 by some outlets, 9 by others. This is extreme fear not as metaphor, but as a quantifiable metric. Combined with the 50% price drawdown, this forms a capitulation-style cluster in which sentiment has bottomed in alignment with price structure. This is the mathematical signature of exhaustion. This alignment of sentiment extreme with leverage collapse is critical. When fear reaches single digits, precisely as open interest is obliterated, it confirms that the selling pressure is mechanical, driven by forced exits rather than strategic distribution. The cluster logic indicates that the market has purged emotional and leverage participants simultaneously. This is not the beginning of a decline. It is the structural footprint of a completed flush. This observation extends beyond mere data. It renders opinion secondary to structure. The system is defined by a mechanical exhaustion pattern operating independently of narrative. When indicators reach these specific thresholds in unison, they signal that the available supply of panicked sellers has been depleted. The shock phase has consumed its fuel. This closes the argument for the shock phase without requiring prediction of the next candle. It is sufficient to observe that the conditions for further cascading liquidation have been removed. The leverage is gone, sentiment is at maximum pessimism, and price has absorbed the impact. The shock has fulfilled its mechanical function, leaving behind a market stripped of excess and prepared for stability. Under the shock pattern framing, the event functions as a system operation rather than a failure. Historical precedent provides structural context. After the March 2020 shock saw aggregate lows around $4,900, the market did not collapse into invalidation, but later reached the $60,000 region in the following cycle. This demonstrates that a severe, mechanically induced shock can coexist with a continuing long-term trajectory without implying inevitability. The shock is a feature of ascent, a mechanism that tests resilience by subjecting the system to extreme stress before resumption. The mechanism is clear. Leverage is reduced, liquidity is repriced, and the foundation is reset. This is not a flaw. It is the method by which the asset transfers from weak hands to strong hands, purging speculative excess accumulated during periods of stability. The 50% drawdown acts as a filter, removing participants unable to withstand volatility and leaving only capital aligned with the long-term thesis. The shock must therefore be understood as a necessary component of trajectory continuity. It is the pause that refreshes the trend, the deep breath before renewed exertion. By clearing the order book of leveraged longs, the market creates the vacuum required for genuine demand to drive the next phase. The trajectory has not been broken. It has been validated by its ability to absorb and recover from a major liquidity event. This locks the classification. The volatility event is confirmed as a shock pattern phase within an invariant trajectory. The narrative of structural collapse dissolves when viewed through the lens of mechanical operation. The system has performed its function, excess has been cleared, and the underlying reality remains unchanged. The path forward is defined not by fear of the drop, but by the structural necessity of resumption.